Okay, we are live back in the CrashLabs Studio with me, Josh Duggan, CJ Cam. So this is an exciting week. Just to kick things off, a couple of things that happened this week. One of which is, Cisco does deal with Goldfields to the tune of $600 million. The other big thing is EarthLabs reports results for the fourth quarter and fiscal year of 2022. So we've got a lot of questions from our investors and participants on the message boards and goodies that would like us to discuss it. So I think, and we'd like to discuss it too. So why don't we just get right in there? Josh, what are some highlights?
Yeah, I mean, let's take us back to Q4 2021. I mean, we reported advertising and subscription revenue of $438,000. That was really the start of when we acquired CEO and later Digi. You know, we acquired CEO, which didn't have a marketing or advertising business. You know, we built that from scratch after we acquired it and started ramping up revenues. But let's flash forward now to Q4 2022. You know, we recorded $4 million worth of revenues into CEO over that basis. You know, a substantial increase, you know, almost 200% year over year when you annualize the number. And, you know, I think it's just getting started. You know, I think what's really exciting with CEO is it has incredible traction, keeps growing, but it was never monetized, was never, you know, captured in the right way. And I think we've delicately built a advertising and subscription platform on top of the existing social network that doesn't frustrate, you know, current users and only brings them quality deals or exciting opportunities from our advertising and sponsors, you know, from the public companies, primarily, obviously, mining companies. And that doesn't alienate them or you know, discourage them from using CEO, but only, you know, encourages them to continue and find new opportunities. So that's been exciting. And flash forward into this year, it's, you know, only gotten larger as we scaled the team and onboard new clients.
So this is interesting because, you know, one of the reasons we liked CEO at the onset when we talked to Tommy and Murat and about bringing it into our universe, notwithstanding all of the advantages and synergies that we have and we see in the other aspects of our business and our future vision, we definitely saw the low-hanging fruit available to monetize and build revenue through to, you know, cover up all the overheads and all the goodies with that marketing division. Now, some of the things we didn't maybe expect to see, which we sort of did, but sort of didn't, was really how much it would have costed and how much time it would have taken to overhaul the site, to recode things, do all of that in conjunction with, because in a vacuum, let's say, without having to invest all of that capital and grow the team to overhaul all the coding and the whole site, on paper, we could have just launched the marketing side of it and, you know, we'd be in the black on that pretty well.
Absolutely.
Pretty well intensively right now. Or at least, so we met our goals on that side, but I guess what affected that was really the unforeseen expenditures and time and everything else that needed to go into like the back end, the site, everything else.
Yeah, I mean, it's been an incredibly taxing experience to you know, to rebuild the site, and we're just at the finish line. And I know we gave some additional early projections of potentially launching that last year. We're still in you know, in the early phases of launching that now. You know, we're onboarding our last beta testers, and then looking in the next month or two to launch that, which is awesome. You know, we've spent a little bit of extra time, you know, fixing up the back end, obviously completely overhauling the front end, and coming up with services and features that I think our users have been asking for years.
Yep.
So we didn't want to rush something that wasn't, you know, up to speed. And of course, like, you know, we look at the site that continues to grow from a user base and page view perspective year over year. You also don't want to build something and rush to build an experience that people won't like either, because you know, it's the fastest way to alienate a community is to overhaul the look and feel of it. Right?
Yeah, you definitely, like, there's a mystique and nostalgia and you know, there's a patina to what people have grown to like about CEO. You want to make sure you preserve all
and we
that.
build, so, you know, I mean, CEO, we build social media first, promotion second, right? So what that means is it's always user first, and you know, we've had thousands of requests from users over the years of looking for these updates, and you know, I think the next update will solve a lot of that issue and give them something pretty exciting to interact with.
And I think people should realize that we're fairly fortunate to have the advertising side to CEO.ca because we're able to essentially bootstrap what we see is the greater vision of CEO.ca. And, that's the reoccurring revenue space where we have users that are paying for level 2 right now, but we needed to overhaul the site, the back end, to be able to, provide cool widgets or the ability to upgrade the tools and, press on the active users in that space to essentially increase our revenues in that particular area. So CEO.ca has 2 revenue streams right now, the advertising revenue and our SaaS revenue or reoccurring revenue. And that's something that we're really excited about because in the past, and, we throw around the term resource quantimental a lot, but it's essentially a tool that we've used to help us make investment decisions. But now with the back end overhauled, we can start taking these tools that we developed and start providing them to the users of this website.
Yeah, cannibalize. A big vision we have for RQ moving forward for this year, for instance, is going to be to take it up, tear it apart into parts, basically, rip it apart and sell it for parts into CEO.ca. And so it's about taking, tools and widgets and things that have come out of that and then making modules that you can plug into CEO.ca that'll enable investors to have these, high-powered tools and modules essentially to be able to, up their game substantially. And so those could be paid for like a premium plus or a plus, CO plus kind of toolkit. So that's kind of our vision with how we're going to take what we've invested in RQ and, break it into pieces for CEO.ca.
And we've talked about one of those products already on the show, which is our drill hole program, right?
Yeah.
Which is in progress now with our data science team and our front end development team, and that's going to be the first big product launch on new CEO.
Yep.
Which I think we're really excited to bring more updates to users, and we'll do probably a special episode to cover that soon.
Yeah. Now, let's move on to the next sort of talking point, I guess. We ended the year with cash and cash equivalents and, our investments in cash of $52.5 million. So that was a wild ride of a year. I mean, we got off of the consulting division, etc., as well as some debt too from the service debt, the deferred revenue. For an aggregate of about 30 million, but I guess in actual cash it would have been 25 minus all the fees and all the crap that you got to pay for it and to come out the other end with. So, I mean, we did that all added into that 52 million bucks. But I mean, maybe a step backwards from what many would have thought. So we took a couple of write downs as well in the quarter. Mm-hmm. I mean, some of them, I guess, when you take your lumps, you take your lumps. And it's if we're going to be, debating with auditors and things about what, needs to be written down, what doesn't need to be written down, or what shouldn't be written down, at some point it's just okay, well, if you're going to write that down, let's write this down. Let's just take all our write downs. Yeah. And I think we got pretty much there with this process. And
I think we were okay with the process. Obviously, a write down never looks good, and we want to... anytime the bottom line is impacted, we obviously don't want that to happen. But in terms of what we're trying to do and what we're trying to build, and we have a lot of smart investors in our stock, and they can see that these are non-cash write-downs. They can back that out and normalize the net income if they really want to investigate the stock in that way. But to be fair, I don't think anyone is looking at us on the bottom line right now because they realize that we're still putting in the pieces to grow. We just sold the exploration tech division. We're sitting on a whole bunch of cash that we aim on deploying discretionarily. But I think this is a good time to touch on the greater vision of what we have and tighten that up for our shareholders. I think people know what we plan on doing in the future, but I guess just to reiterate how we're going to use CEO.ca and DigiGeo to do so.
Okay, so where's a good place to start? I think maybe we could start with looking at the TSXV. Steph, do you want to pull up TSXV? So this is a good one.
Yeah.
I mean, so here's the venture looking back to 1991, 1990. I mean, it's going back pretty far. But I guess, maybe what should be, more relevant to people looking here is that like sort of 2005 onwards. And, we've been talking about being finally in the swings of a bull market and everything else in gold, and the venture still sucks, guys. It's still in the absolute toilet of toilets. Mm-hmm. It's not, this is not a bull market yet. We're not there yet. Right. And so part of what we are now is a combination of an investment issuer that has a large amount of cash and equities and securities. We've got a good analytics team, a strong team analyzing and searching for opportunities to deploy that capital and place it in good things. And in many ways, we're in these like sort of tumultuous, bear market conditions. And this is really the longest one we've had for, ever, I think, for the,
Yeah, if you look at the other chart, it really puts things into perspective here. So
yeah, there you go.
Yeah.
We were looking at the raw data before, but how we defined a bull market is a rise of 20%, extending over 2 months at a time, and a bear market, the opposite of that. And, if you look back to where we first had that dip back in 2011-ish, we're very much still in that bear market. We haven't had very big recoveries. We thought we were starting to see another bull 2020-ish, but, we quickly backed off of that. So this is definitely the longest bear market that the TSX venture has been mired in. And, a good, I guess, rule of thumb here is anytime a bull market happens after a bear market, it's normally harder and 2 times as longer. And, that's what we're positioning ourselves for right now.
Yeah, we think it's going to be big. And honestly, so it's a buyer's market. It's a market where we're, obviously still deploying our capital because we want to catch that lift when it happens. But at the same time, one of the interesting things to remember of when things become bullish. And so when we get into that bull market, we have to look at a couple of things. Like if we're going to be an investment issuer, so I'm screwing my investment issuer, hat on right now, talking about our strategy. And one of the things that happens is the cost of capital goes from expensive to cheap. And what I mean by that is right now, cost of capital is expensive. There's not a lot of capital swirling around. If you're doing a private placement looking for money, there's very few pockets that are willing to scratch you a check. And so you're seeing people bolt on warrants. You're seeing people, doing check swaps with marketing companies, et cetera, to try to bolster their book, to try to stuff their financings, to hit their, magic marks. I'm out to raise 3 and I can't quite get to 3. And so I'm going to, do a deal with this company and that company and that company. And, I'm check swapping $500,000 to get it over the line. And we see that. So right now, cost of capital is quite expensive. But what happens very quickly and very vigorously is that cost of capital gets cheap, which means there's a really an abundant amount of money being thrown at companies in a bull market. What that means for an investment issuer is that the conditions to get a position in a private placement become competitive. And this is not to be understated. And so as an issuer being in the room and in the deal and connected to people, we want to leverage that to give people the deepest sort of first exposures into some of these highest value, deepest value, kind of earliest exposure into some of these deals. And quite frankly, right now, let's say an issuer with a fantastic asset will call us and say, we're raising $10 million. And we're saying, okay, we'll take $1 million of it. Great. You got your $1 million. But what happens in a bull market is there's way more sources of capital than just us, family offices around the world. Everybody's getting in there. So you need some sort of a competitive edge. And that's where CEO.ca, DigiGeo in many respects, and our podcast will give us that edge. Having the distribution of CEO.ca means that when that amazing sweetheart deal comes down the road, and we all of a sudden want to say, hey, listen, we want to participate for $2 million. We know this is a hell of a deal. We want to get in for $2 million. We're not going to get a call back in 2 or 3 days saying we've been cut back to $400K. We're going to get our fill. or we're going to get at least a bigger fill because they know that we have a podcast that we talk about the things that we like. We also have CEO.ca, we have reach, right? So there's going to be, that's the competitive edge, and you can't build that reactionarily. By the time that market comes around, it's too late. It's the same with GoldSpot. GoldSpot had a very incredible business model, but we designed it in a market and we built it out in a market such that when the market started playing ball with us, we were ready to go. Our infrastructure was in place and we could leverage it. It's the same right now. You're seeing us do this podcast, for instance, or we've got CEO.ca. We're overhauling it, making it better. We're investing in this pipeline. We're really building that scaffolding, that infrastructure such that when that market turns, we can maximize our yield when the times are really, really good. And so it's about, right now, it's about making smart bets with our money, making smart investments, being cautious about it, but also being strategic. And also with regards to investing in our various platforms, making sure that we're in a position that everything's working well and such that when, millions of new retail investors flock into this space, CEO is a great place for them to consume content. Right? You don't want it to be some clunky or old version that's breaking all the time or it's down for this or that. You want it having the functionality and things that they've grown accustomed to getting at other more modern things. And so I think that's a really important kind of strategy to vision to lay out to our audience. Did I miss anything?
No, I think when you distill the vision, and it is written in the corporate presentation right now, but we want to maximize the torque to the junior resource space, and we have 3 business lines to do so. We will be investing on a discretionary basis, but we also have the other arms to lean on to ensure that we are these value-added investors come time. We know that the royalty portfolio is getting no love, no value right now, and we're looking at options on what to do with that. And the last line, the media line that we went to in depth, it's majority bootstrapped right now, and we already have we already spent the money in development on a lot of these widgets and value new services that we're going to be putting onto the platform. So I think we're in a great space right now. It's just a matter of executing the ideas and keeping shareholders in the loop, but. I think it is. It's not going to be. It's not a trade. We're not a trade right now.
No.
Like there has. It's a long-term vision, and we're gonna keep to our mandate, and we know it's gonna play out just because the markets are cyclical, and it always plays out.
And I want to pull back to the subsidiaries for a second because I think it's important to recognize a few things. So we bought CEO. It was a website. Now it's a business. We built it into a $4 million a year business, which we expect to exceed this year and continue to grow, and not just advertising and subscription, but additional services along the way into a sustainable company that will continue to yield cash for us go forward. And then let's look at DigiGeo. We bought it again, early stage SaaS company. Incredible founders that built up in Tierra. That created the industry standard hot play maps. That have their little map business that they've been running. That is the industry standard. It's on every single geo's wall. For every hot play map they do, but they recognize that physical maps were not again a long-term business. They wanted to break into digital. We acquired them as they started building that process, and now again they're only 15-20% of the way there to building their full complete platform, but they already have. Tens, if not hundreds at this point, of public companies that are subscribing to their premium services. They're in the midst of launching their, retail mapping business, right? Like Digi's broken into really 3 things. Their maps, which are the physical component, and now a digital online geospatial mapping site free for investors called, maps.digigeo, which they're, again, launching a new update in the coming weeks. They have Atlas, which is their subscription platform for public companies that have all the underlying geo data that is much more complex, including drill holes and technical reports and other things. And then they have DigiGeo Data, the database that you can query and search. If you want to find a list of every single silver project in Nevada was filed a 43101, you go through there, and they have, or in Guatemala or wherever in Peru. they have all that information. So they are, as they build up that data and some of the geological data sets they've even put in haven't actually ever been visualized before. So as they launch that data first mentality, they've gotten fantastic feedback, especially when they launched, their drill hole preview at PDAC. A lot of their clients said, whoa, shit, I want this. So it's great to see that evolving as well. And we expect that to be on the same course as CEO. And again, like you said, Denny, it's one word for both those things. It's distribution, and it gives EarthLabs that step up that no one else has.
Yeah, and I think what's interesting for people to recognize maybe about DigiGeo is that there's a lot of interplay between DigiGeo and CEO in the future.
Absolutely.
There's a lot of things that you can take, whether it be financial data and some of the things that we're mapping out. We're talking about resource quantimental and some of the widgets and plugins and things that work. And so there's a lot of benefits that we can inject into CEO.ca from that library, let's say. And similarly, there's a lot of things that DigiGeo can benefit from. So if we just take our Q alone, then if we take DigiGeo and CEO, there's a lot of cross-pollination that happens there. Injecting more spatial data into the CEO experience for people, injecting financial data into that experience into the spatial environment that DigiGeo's, and really the customer base for these two things is totally different. So in many ways, you're building up, like the level of depth and detail are going to be different on both sides, but you're building up sort of two things that share a lot of back end with each other, a lot of sourcing from each other. And so there's a lot of cross-pollination between those entities. And so it's going to be interesting. The goal here for me, for us at this table for now is we have a very short-sighted vision of financially stabilizing both DigiGeo and CEO.ca, getting them to a break-even profitable point for us as a company. And then making sure that we're deploying that capital and leveraging our capital as investment issuer very smart. That should be our exponential upside could be yielded there. But then in the long term, both CEO and DigiGeo have very, very, very deep value propositions for enhanced subscription revenue services and yields. And so much these things can be, they can grow into very significant, valuable SaaS companies that can give us a ton of revenue. And that can, recapitalize our coffers in the long term. So we're very happy to have the blend of things that we have. Notwithstanding this podcast, as silly as the podcast may seem, it has a real strategic value to us to be able to build an audience with you guys, to be able to talk about what we're doing, what we like about the industry, what we don't like, all that stuff, and bring everybody along the journey. It's about building content, so such that when droves of new shareholders come into this space, that there is a place that they can come that's not paid for content. There's tons of paid to play coverage out there in the space. It's pretty much all that exists. If you look for CEO interviews, on other platforms, other podcasts, it's all very boring question, answer, question, answer, question. My name is Denis and my project is in Abitibi. Like we're not that.
Right.
And so it's a new, fresh kind of repository of video content, data, discussions. In the future, we imagine going through, some of the new tools as we launch them, how users can use them better and take people along that journey with us. And so it's going to be very, very good. But Rome wasn't built in a day. You got to build it in pieces. It takes time. So this is a builder year for us.
Mm-hmm. So we hope that answers everyone's questions in the meantime here. But if you have any more, feel free to ask them, and we'll always try to address them. These Crash Labs come out every week, so happy to answer, guys.
Yep. Stay tuned, and then we've got I think in another month or so, we've got our Q1s coming out
soon.
So that should help recalibrate some expectations and some everybody's kind of questions there. So stay tuned for those. What else do we want to talk a little bit just before we go? Do we want to talk about our spending expectations on?
I think we should. I mean, obviously, when we sold GoldSpot, we put some aggressive, potential projections of what could be allocated to the underlying subsidiaries over the course of this year.
Like RQ, DigiGeo, CEO,
right?
all that.
And I've seen, I think, a fair amount of questions online about that. So maybe we can clear that up. I know, speaking obviously from the CEO side, considering the increase in revenue we've seen just in the last year and throughout this year, we haven't seen a need at this point to rely on any additional funding outside of what we're making, to allocate towards the the front end, back end spend. So from a projection standpoint of where we were at close of the GoldSpot deal, our spend on CEO is looking substantially less.
Like a few $1 million.
Absolutely.
Yeah. And then on the DigiGeo front, I think we have a good idea of what that is. I mean, we've Glenn hasn't really changed all that much other than us injecting some new tools and things.
Again, similar standpoint. Self-funding, bootstrapping, I think as CJ put it perfectly, with some of our additional subscription services now. A lot of the additional spend we had allocated this year no longer is necessary. So we're able to retain that cash for some of the deals you're talking about instead of deploying them into the subsidiaries.
And I think moving forward, we are going to start breaking out the financials so people can keep track of the spend on each of our subsidiaries, and that'll allow them to kind of assess, I guess, the future growth on more of a granular level.
Yeah. RQ's in the chop shop, so it's not going to have any direct spending other than that'll be captured in the spending that we just discussed for both CEO and Digi.
Exactly.
In terms of repurposing some of those pieces for that.
So I think that's exciting in itself, and we've built the previous companies in a bear market, and we've shown that how much value we can unlock in doing so. And I'm excited because we have this cash, we have the investments to deploy in a bear market, and no one else can say that right now. We're seeing awesome companies, awesome projects, and
we got a hell of our portfolio since sort of January of this year. We came out of the gates pretty strong, and we put together a hell of a basket. So
yeah, we're so well positioned right now. I'm so excited.
It will be tough. It will be tough, though. That's one thing I think to clarify with people too, is that with the new strategy, of course, going backwards to GoldSpot, the mandate was different. GoldSpot. GoldSpot was offering services. And so what the ideal candidate for investment was not just the best company that could possibly be invested in, the best, opportunity. It was the best opportunity with the team that needed us the most, that had the data that we could work with, that we could dig into and have the best, there was a whole laundry list of criteria that would fall outside and change what the, what sort of like the checklist of things that we would look for as a strategic investment with old GoldSpot consultancy driven business versus the new way. And so, I mean, one of the problems is that now we've got a new kind of portfolio with the sort of new basket of investments that we have. And that's going to be conflated with on the financials to some degree. And we'll try to break that out. I think we can as like a bullet point or something in the MD&A or in the discussion or something like that. But
well, how about, which one of these are legacy investments?
Yeah, it's going to be jumbled. Like the legacy investments with the new stuff is going to be a bit jumbled together. Yeah. So it'll take some time before it's clean and, we don't have to worry about, the performance of new investments getting jumbled around with the performance of the old ones.
That's a good point.
Yeah. Okay. Well, look, that's it. We're thrilled. We got another, big month ahead of us here before the next batch of financials comes out. But, expect a lot more news from us. And, one of the things that we're experimenting here today as well is just like, we've got to do a lot of message sharpening from our perspective. I mean, we always talk about, and I've actually somebody appropriately put the comment on our board that we talk about being able to tell our story better or tell stories better than others. And I guess that's true as far as discoveries goes. But as far as like EarthLabs, this new business model, we haven't done a very good job of communicating or discussing what our plan is and what that elevator pitch is on us. And so that's something that we're crafting, and we hope to time. It's a hone. It's a honing thing. You start with a bunch of stuff, and you know what you want to talk about, but then you've got to sort of hone it into a lethal weapon of a pitch, right? So I think we're getting there. This is a bit of an experiment today with talking everybody through what we're hoping to get out of CEO, DigiGeo, our investment portfolio, the macro market, the timing, etc. So anyway, any comments or feedback on that stuff, always welcome. We do read the comments. Some of them are silly, some of them are great, but all of them welcome. Okay, thanks.